Welcome to the FedLife Podcast with Dan Sipe from Serving Those Who Serve. In this podcast, Dan draws from years of financial experience to help federal employees overcome challenges that every Fed can relate to. Join us for this journey as we reach, teach, and serve to help you make the right financial decisions. Now, on to the show.
Hello and welcome to this episode of the FedLife Podcast. I am your host, Dan Sipe. Additionally, I'm the branch manager here at Sipe and Associates and Serving Those Who Serve. And I want to begin, as I always do, by saying thank you. Thank you for taking time to listen to this, and more and more and more and more of you are listening every month. It is gratifying to see. We're going to do our best to keep coming up with stuff that you want to hear. But also, I want to say thank you for your service. You don't hear it enough. You should hear it everywhere. You do not. I'm doing everything I can to fix that. You will always hear it here. Thank you for your service. The other thing that you always hear here is the guru, Ed Zurndorfer. He is back with us once again as part of our ongoing mission to reach, teach, and serve you. And at the outset, I need to say the opinions of our guest, Ed Zurndorfer, are not the opinions of Raymond James or Serving Those Who Serve. This podcast is presented for information only and is not intended to be taken as advice. All listeners should consult their personal advisors before taking any action. And if you don't have a personal advisor, hit us up at Serving Those Who Serve. We'll do what we can to help you. And once again, as is our wont, we will follow Ed's FedZone articles to give you one more way that we can reach, teach, and serve. So Ed, we jump into a new leave year, and you have offered your wise counsel with 10 things our feds should do. I know your article deals with calendar year 2022, but it really seems like a lot of this stuff is good practice for every new year, correct?
That's absolutely correct. Dan, I am so excited to start of a new year, and
Absolutely.
That means that we have to come up with some goals, some New Year's resolutions, among other things with regard to our finances. And this should be true every year.
Absolutely. And I would be remiss if I didn't say Happy New Year, Ed. I know we're not supposed to break the fourth wall here and acknowledge that it's time, but yes, this is our first one of the year. And so next year it'll be easy for you all to find if you want to listen to it again. So let's get us rolling, because your first one, is to make choices for the thrift savings plan. What are your key points there?
Absolutely. Thrift savings plan is dear to many hearts of federal employees and retirees like myself. I have my TSP account. I retired from federal service about 16 years ago. I've kept my TSP, and every year I look at it to make sure things are still on track. But among the important choices for 2022 include, for employees, how much to contribute to the TSP during 2022. The actually amounts that we're going to talk about here in a moment actually have gone up. The amount that they can contribute to the TSP. Of course, Dan, have to remember, all contributions, direct contributions that are made to the TSP have to come from one's paycheck. One cannot contribute to the TSP from their retirement money. It has to come from their paycheck. So they have to be still working for the federal government. So they have to decide how much they want to contribute during this year. Other choices are which type of TSP account do they want to contribute to? Namely, do they want to contribute to the traditional TSP? Do they want to contribute to the Roth TSP? Or both? They actually can contribute to both accounts. And then the other choice they need to make is reviewing their TSP fund allocations. Are they really investing in the right funds? Namely, are they putting money into the C, S, and I funds, the three stock funds, or are they contributing to the bond funds, the two bond funds, the G fund and the F fund, or are they contributing to a particular life cycle fund? They have to make sure that they're on track to meet their goals, their financial goals, with respect to their contributions that they're making to the various funds.
No, that makes sense. And, one of the questions that we ask all the time when we meet someone is what is your investment strategy? And Ed, you'd be surprised how many people don't necessarily have one.
Very important, Dan, to have an investment strategy, a goal, a retirement goal. Just want to point out that the TSB is not just your everyday savings account that you put money into it and then immediately spend it to pay your bills. This is for the long term, for the retirement, that they'll have the money from their TSB account once they retire from federal service to help pay their expenses in retirement. Ideally, they want their TSB to grow continuously, both now, when they don't need the money, they don't use the money to pay their bills, but for even in retirement, the money has to continue to grow. So there has to be enough money in their TSB account by the time they retire. And at a minimum, Dan, I recommend that employees, most of whom are now FERS employees, contribute at least 5% of their paycheck into the TSB every pay date. And the reason I'm saying that is if they contribute at least 5% each pay date, they're getting the maximum matching contribution of 4% from their agency. Dan, those matching contributions are what I call free money. Free money.
Yep.
And they'd be foolish not to take advantage of that free money. Again, how would they get that free money? By contributing at least 5%. But don't get me wrong, Dan. They shouldn't stop at 5%. Ideally, they should contribute the maximum amount possible to the TSB in 2022.
Absolutely.
The 5% is minimum. So what is that maximum contribution? It's $20,500. It went up from $19,500 for that's for all employees no matter what their age is. Went from $19,500 in 2021 to $20,500 in 2022. That's a $1,000 increase. If the employee is at least age 50 this year, they're going to be over age 49 as of the last day of 2022, then they can contribute an additional $6,500 in so-called catch-up contributions that was not changed from 2021. Bottom line is those employees over age 49 as of December 31st, 2022 can contribute a maximum $27,000 into the TSB for 2022. It was $26,000 in 2021. Employees should make every effort to maximize their contributions to the TSB year in and year out.
Absolutely. Absolutely. And next, you want us to check on our health, dental, and vision insurance. What point are you making there?
That is correct, Dan. During the open season, which was concluded back in December, the open season was from November 8th through December 13, 2021. But anybody who changed their health insurance, dental, and their vision insurance, those changes they made to their plans, to the type of plan they have in terms of high deductible, low deductible, if they stay within the same plan. Bottom line is they took effect. They took effect when it comes to health insurance. They took effect as of January the 2nd, 2022. If they changed their dental plan or they changed their vision insurance plan, the changes took effect as of January 1st. But here's my point here, that employees who change their plans have to check with their doctors, their dentists, their ophthalmologists, their optometrists, their pharmacists, the places they go for blood tests, the laboratories or hearing tests, to make sure that these individuals, those organizations, doctors' offices, etc., are aware of the change in insurance. They have to contact. And the reason I'm saying that, Dan, is the doctor that you go to may not accept your new plan. They may not be associated with the new plan. If it's, let's say, your plan is a PPO, a preferred provider plan, not all doctors may participate in that particular plan. You have to check on that. So it's very important you do your paperwork, that you make sure that the dentists are aware of any changes in your insurance. Most doctors' offices, by the way, will notify you about that. So that's a very important thing that employees as well as retirees have to do.
And number 3, you bring our attention to healthcare flexible spending accounts.
Yes, our healthcare flexible spending account, which includes the regular healthcare FSA that pays for any type of out-of-pocket medical, dental, or vision expenses, those accounts take effect as of January 1st, 2022. And what do I mean by take effect? At that point, employees who are enrolled in the healthcare FSA who incur expense in which the healthcare FSA will reimburse the employee or pay directly the provider of the service. At that point, employees can now apply to get reimbursed or have their expenses paid. If they enrolled in the other type of healthcare FSA, which is a limited expense healthcare FSA that only pays for dental vision expenses, the same thing is true. So any expenses starting this can be reimbursed or pay directly the provider of the services. The deadline to spend one's money is December 31st, 2022. Now, however, I want to point out that if employees who did participate in the healthcare FSA or the limited expense health FSA had any leftover expenses for plan year 2021, they were allowed to carry over those expenses up to $550, and they also need to be spent during calendar year 2022. For this year, at the end of this year, there's a carryover limit of $570.
Gotcha.
Also, keep in mind that if an employee retires sometime during 2022, any of the money that's in healthcare FSA or limited FSA has to be spent by the day that the employee retires. They cannot incur these expenses after they retire and get reimbursed with their account.
Gotcha. Okay, the next two up actually have to do with taxes. So number 4 is a form that most feds will be receiving if they haven't already received. You want them to review their W-2 for the previous year.
Oh, yes, Dan. As an accountant, I'm an accountant. I have accounting and tax practice. And I get lots of paperwork during this time of year for people when they want to get their taxes prepared, one of which is the W-2 statement. And unfortunately, I have seen errors on these things. One of the typical errors is that the amount of taxable wages has been misreported. The amount of federal and state income taxes that are withheld has been misreported. The Social Security wages has been misreported. The amount of contributions that one made to their TSP account has been reported incorrectly. Mm-hmm. So these are things that are going to affect one's tax liability, federal and state, for 2021 on their 2021 return. So I urge employees to check their W-2 statement for accuracy. And people ask, well, how do I do that? And my suggestion is look at your last leave and earnings statement for 2021. The last leave and earnings statement you received will show you the cumulative amount of your taxable wages, the amount of federal income taxes that was withheld during calendar year 2021, state income taxes, the total amount of taxes withheld. This will be under the cumulative column of your LES. Sure. The amount of your TSP contributions that were made in total for 2021. Please double check that what you see on that last LES statement matches what's on your W-2.
Gotcha.
Because if it's wrong, you have to contact your agency payroll office or your HR office to contact payroll to have your W-2 corrected. Do not file your taxes until you're absolutely certain that your W-2 statement is correct.
Good advice. And tailing on to that, you advise our feds to review their federal and state tax withholding for the current year, correct?
That is correct. What I suggest here is that if employees have a gut feeling that they're going to owe a lot of federal or state income taxes when they file their 2021 taxes, they have a gut feeling, they've done, let's say, a tentative calculation. Ideally, the employee at the end of 2021 or maybe November maybe had a meeting with their accountant to do a tentative calculation of what they think they're going to owe or get back for 2021 when they file their taxes. And if they find that, they're going to owe a lot of money, and how do I define as far as the federal is concerned as owing a lot of money? You owe more than $1,000. Then maybe this month start having more federal income taxes withheld from your paycheck.
Gotcha.
More money,
Gotcha.
whatever you feel is going to be the right amount to be withheld in order so that you do not have such a large balance due for 2022. But you need to do this as early in the year as possible. Don't wait till next October to figure out you didn't have a lot of money taken out. Dan, I hate when clients contact me in November. Oh, I think I better do an end-of-year analysis as far as changing my withholding. I said, it's too late. The best I can do for you, I can figure out what I think you're going to owe. But if you owe a lot of money, the best thing to do, here it is, November, December, is to make an estimated tax payment, which is due in the middle of January. This way you won't owe a lot of money when you file your taxes in April, and you won't be subject to what's called an under-withholding penalty. Now, if you find out, wow, I'm getting a big refund back based on my analysis, I put a lot of money into the TSP, the traditional TSP, that reduced my tax liability. That's great. That's great. Maybe as a result of that, you're going to get a lot of money back. Maybe for this year, put more money into the Roth TSP, in which you're not going to get a big refund back. You're going to get money because the Roth TSP is made with after-tax dollars. There's no tax savings up front. But you will be rewarded down the line when you take money out of the Roth TSP not to pay taxes. It's so important at this time of the year to do this analysis from the standpoint of your tax liability for the upcoming year. Also, it has ramifications as far as which TSP account you want to contribute to, traditional or Roth, based on your overall analysis.
Gotcha. Number 6 is a teeny bit time sensitive, and that's make an IRA contribution for the previous year, if that's appropriate. Correct?
Yes. One of the things that many federal employees forget is that they're eligible to contribute to an IRA. I mean, I've heard this from some federal employees, Dan. They say to me, I really would like to contribute to an IRA, but I know I'm not eligible. And I said, why aren't you eligible? Well, because I put money into the TSP, I'm not allowed to contribute to an IRA. Dan, nothing can be further from the truth. There's only one qualification to contribute to an IRA. You or your spouse has earned income. Earned income is a salary. Federal employees worked some part of 2021, maybe all of it. They got a paycheck. Therefore, they are eligible to contribute to an IRA, and so are their spouses if they're married. There are different types of IRAs. You have traditional IRA, you have Roth IRA. Within the traditional IRA, you have what's called deductible traditional IRAs, and you have non-deductible traditional IRAs. The type of IRA you're allowed to contribute to is based mainly on your income, your adjusted gross income. And that being said, at this time of the year, in January, and it's now January 2022, we will know what our income, our adjusted gross income is. We'll have a good idea sometime this month or next month. You have until April 18th, not April 15th. The deadline for filing 2021 taxes is April the 18th, 2022. You have until then to make that contribution, that IRA contribution for 2021. I'm saying it's a good time of year because you'll know at least by the end of February what type of IRA you are eligible to contribute to. And you have until April 18th to make that contribution. And in my Fed Zone column, which came out on January 5th, it talks about the different types of IRAs, who can contribute to which type of IRA. So given your adjusted gross income, it's all detailed there. If an employee is going to make an IRA contribution for 2021, make sure that they tell their IRA custodian, Dan, that the contribution is for 2021 and not for 2022. Because if you don't say anything, the custodian will say, oh, okay, well, it's a 2022 IRA contribution because it's calendar year 2022. You have to be very specific. It's for 2021.
Very true. Very true. Now, number 7 and 8 are things that a lot of folks just may never think to do. You recommend reviewing life insurance coverage, but also checking the beneficiary designation on the federal benefits. Talk us through those.
Very important. When somebody buys a life insurance policy, let's say in their 30s, late 20s, 30s, for various reasons, they got married, have a family, they took on a big debt like a mortgage. You just can't put your life insurance coverage on autopilot. It just it never changes. Things may happen during your life that may necessitate, updating your life insurance coverage, maybe buying another policy. Maybe you need life insurance coverage for longer than you expected. Most term life insurance policies, the longest it's going to last is 30 years. I heard maybe 40 years. I have not been in doing. I am a life insurance broker, but I don't sell insurance. I haven't done any selling of life insurance for years. But the fact of the matter is, if somebody buys a policy when they're 30, it's a 30-year policy. Something may happen subsequently when they're in their 40s and 50s that may necessitate having a policy that goes beyond age 60. They bought the policy when they're 30. It was supposedly good for 30 years, but they're going to need, let's say, life insurance coverage until age 70. They have to buy another policy. And hopefully they're well enough. The premiums are going to be more expensive because they're older, but they need to sit down and evaluate their life insurance needs at various stages of their life. This is a good time of year to do it. Now, at this time, beginning of the year. And if they need some assistance, contact a financial planner who has an insurance license, someone who understands life insurance, and most importantly, will maybe help the person evaluate their life insurance needs. As far as beneficiary form designation is concerned, I always recommend that no matter what type of financial asset you have in which you can name a beneficiary, including life insurance, including the TSP, including an IRA, even including bank accounts, because you can name a beneficiary of a bank account. It's called a POD, payable on death, or a brokerage account. You can name a beneficiary. It's called a transfer on death, a TOD. Make sure those beneficiary designations are up to date. You may have named, let's say, a spouse as the beneficiary of your life insurance policy when you bought it. Here, you're 30 years old, you're married, you bought a life insurance policy, and your spouse is your beneficiary. But then, unfortunately, you got divorced from that spouse. You better change the beneficiary designation.
Oh, yeah.
The courts have ruled if you didn't change that beneficiary and you pass away, and that former spouse is still dead, this former spouse is going to get it. I'll give you another example. I ran into a situation, Dan, in which a federal employee entered federal service about the time I did, around 1972, fresh out of college. And he was single, and who does he name as a beneficiary of his FEGLI? His parents. Mom and dad, each 50% beneficiary. Well, this employee subsequently got married, wife, had 3 children, the year never updated the FEGLI beneficiary form SF2823. And he died in 2004 of a massive stroke with $600,000 of FEGLI life insurance. Who went to who? His parents. Only one problem, Dan.
Ouch.
His parents had passed away.
Yep.
What had to happen here is that his parents' estate had to be reopened. You're talking about legal fees. You're talking about a big delay. His wife and children eventually got those life insurance proceeds, but at a big delay and a big cost. Not a smart move.
Yep. Check those designations,
Always important.
folks. Yep. So number 9, really important coming out of the holidays, and that's review those credit card balances and general debt level. Because some folks, I don't know, they're a little more generous around the holidays, and next thing you know, they're not necessarily paying attention to what those balances are in January. So give us your thoughts there.
Yeah, I would look at the situation now that the credit card bills are coming in January. Make sure that we're able to pay it, in full, please. And if not, make every effort to get it paid off as soon as possible within the next month or two.
Absolutely.
And Dan, I want to make another suggestion is for those federal employees who have huge huge credit card bills, do not take out a TSP loan to pay off the credit cards. Not a smart move. Do everything possible to get paid off, even if you have to get a second job. I've known people who've done that. They've taken a second job just to pay off their credit card bills. That would be a very smart move.
Yep. Couldn't agree with you more. And you wrap up with advising our feds to pull up and review that Social Security statement. That is so important because they're not mailing them anymore. And, you know, with more and more feds being FERS, Social Security is going to be a big part of that. So give us your thoughts there.
Absolutely. It's a free thing. All you got to do is go to the Social Security website, set up your own account. And this way, when you set up your own account, you're able to look at your benefits statement. Like you said, Dan, it used to be mailed out, but this way you're allowed and you only would get these statements mailed to you every 5 years. Now, when you have your statement online, you're able to look at your statement 24/7 to see what your anticipated benefits will be as calculated by the Social Security Administration when you're 62. At your full retirement age 70, what family benefits would be, what disability benefits would be if you got disabled. You can look at it. Also, as part of your statement, Dan, they tell you what your earnings history is. They give you a listing of all your Social Security wages back to day one when you started working. The reason I'm saying that is, who is Social Security getting that information from? From your employer. Your employer sends a copy of your W-2 statement to the Social Security Administration at the end of January, a copy of your W-2, and box 3 of your W-2 says Social Security wages earned in the previous year. Those Social Security wages are used to calculate your benefits. Is it possible, Dan, that your employer may have misreported your Social Security wages? Is that possible?
No, that couldn't happen. Could it, Ed?
Unfortunately, it has. And whose responsibility is to make sure that the amount of Social Security wages has been reported correctly?
I'm going to guess that's me. Yep.
So it's important every year to look at your Social Security statement. Let's say around April or May, maybe a little bit later, to make sure, in this case for 2021, that the amount of your Social Security wages for 2021, as shown in box 3 of your 2021 W-3, has been reported correctly to the Social Security Administration. So that Social Security, when they calculate your benefits this year, and they do every year, based on your 35 highest years of Social Security earnings, that they're using the right numbers. As they say, Dan,
absolutely.
Junk in, junk out.
Junk out. Yep. Well, Ed, that is a great top 10 list, and I think it's evergreen. I think it's a good thing for people to review every single year. So, folks, be sure to share this with your friends and colleagues. It's going to be up there. We have it all archived. It's pretty easy to find. So if Ed does a different first column of the year next year, this will always be there for you. And I think the advice here is solid from year to year. Brother, you are truly a treasure to us in the federal community. We appreciate all that you do, especially all that you teach this team. And folks, that is a wrap. We are Serving Those Who Serve. Be sure to subscribe to this podcast on our YouTube channel and Spotify. Please share it with friends and strangers. Check us out on Twitter and LinkedIn. And don't forget, live webinars every week. We never stop. You will have the guru coming to you. So go to stwserve.com. You will see the big blue webinar button. Click it, and you will see we have tons and tons and tons. Up there, the guru comes to you. We work to reach you where you are, teach you where you are, and above all, serve you where you are. Sign up for one, sign up for all. Share that page with your friends. They will thank you. Be sure to read Ed every single week in the Fed Zone. That's fed-zone.com. And I'll say it again because compliance will probably remind me. There's a lot of great information that we covered here. It's not meant to be advice. If you have an advisor, talk it over with them. If you don't have an advisor, hit us up at at Serving Those Who Serve, that's scwserve.com. So for Ed, the crew at Serving Those Who Serve, and me, Dan Sipe, good luck, Godspeed, Happy New Year, and remember, it's your Fed life. Make it a great one because you deserve it. Stay well, everybody. We are out.
Thank you for listening to the FedLife Podcast. Click the subscribe button below to be notified when new episodes become available. The information covered and posted represents the views and opinions of the guest and does not necessarily represent the views or opinions of Serving Those Who Serve or Raymond James. The content has been made available for informational and educational purposes only. The content is not intended to be a substitute for professional investing advice. Always seek the advice of your financial advisor or other qualified financial service provider with any questions you may have regarding your investment planning. Securities offered through Raymond James Financial Services Incorporated, member FINRA SIPC. Investment advisory services offered through Raymond James Financial Services Advisors Incorporated. Serving Those Who Serve is not a registered broker-dealer and is independent of Raymond James Financial Services.
Raymond James is not affiliated and does not endorse the opinions or services of any of the quoted professionals or their respective firms. Any opinions are those of Dan Sipe and not necessarily those of RJFS or Raymond James. This case study is for illustrative purposes only. Individual cases will vary. Raymond James is not affiliated with and does not endorse the opinions or services of the quoted professionals or their respective organizations.
Neither Raymond James Financial Services nor any Raymond James financial advisor renders advice on tax issues. These matters should be discussed with the appropriate professional. Investing involves risk, and you may incur a profit or loss regardless of strategy selected, including diversification and asset allocation.